Okay, I can admit when I'm wrong. You can stop sending me messages. If you saw my video from a few days ago, I talked about how, while it wasn't impossible that we wouldn't see a rate hike on June 7th, that it was highly unlikely, and that if there was going to be a rate hike, we'd probably see it in July, not June. Well, as you know, we saw one in June. And even though the rate hike was relatively small in the grand scheme of things, it was only 0.25%, it is still significant. So let's talk about the 5 things that this may mean for Canadians. Number 1, and yes, you probably guessed this, there are likely more rate hikes to come. The Bank of Canada, in their decision on June 7th to increase interest rates, suggested that the culmination of data warranted a rate hike, from all of the information that they had collected on employment, to the core inflation numbers, to the previous quarterly report. And if that's true, to me, that suggests one of 2 things. Either number 1, the Bank of Canada is willing to go off relatively little information. As long as it's pointing in the wrong direction, the Bank of Canada is going to be willing to step in to increase interest rates to battle inflation, in which case, when the monetary policy report comes out on July 12th, they're going to have more than enough information there to warrant yet another rate hike. Or number 2, the Bank of Canada knows something that we don't, in which case it's probably worse than we all think it is, and the Bank of Canada is going to warrant another interest rate hike. Either way, what this means is we're probably going to see another interest rate hike, and my guess is on July 12th, which also means that we're going to see these higher interest rates likely last longer than we were originally hoping for and anticipating. Usually it takes about 18 months for an economy to feel the full effect of a rate hike cycle, but obviously depending on the severity of the rate hike, you might start seeing some of those effects impact the economy sooner, like we've been seeing. And yet, here we are 15 months later, and the Bank of Canada still finds themselves in a situation where they feel that rate hikes are still necessary. Now, historically, before rates start coming down, we usually see a rate pause of about 6 to 13 months. But we have seen in the past a rate pause as low as 3 months before rates were adjusted downward. And depending on the severity of the recessionary pressures that are building, that still is technically possible. But obviously, with the Bank of Canada still on an upward trajectory with rate increases, that does increase the likelihood that these rates are going to be around until sometime until 2024. Number 3, because of those first 2 things, more rate hikes to come and higher rates lasting for longer, when a recession eventually does come, you're going to see it likely be significantly more severe than it otherwise would have been for a particular group of people, particularly low-income to low-middle-income families. We're already seeing a lot of pressure on these families, even right now, and they're starting to cap out on their credit. In fact, in a lot of the cases that we're seeing already, a lot of these families have not only capped out their credit, but their monthly costs, along with the interest that they have to pay every month, is more than their monthly cash flow, which eventually means that once they run out of credit capacity, they're going to be forced to reduce their economic activity because they're going to have no credit within which to partake in their credit activity. And worse yet, when the recession eventually does come, they're going to have no credit to fall back on. On a separate side note, I do think that some of the economic activity that we're seeing now is borrowing from economic activity in the future. There still seems to be a mentality that the cost of something tomorrow is going to be more than the cost of something today. And a lot of people are factoring that in to their purchases. But I do think eventually when that tide shifts, when that tide changes, and people feel like they have more to gain by waiting for the price of something to come down, I think you're going to see a whole lot less economic activity. And that will be a strong recessionary pressure that the Bank of Canada will need to address. It's just whether or not that starts prior to 2024. Number 4, we can't ignore the effects of quantitative tightening. There have been many articles focusing on the fact that the Bank of Canada has increased interest rate, and yet very few that I can find that have focused on the fact that the Bank of Canada also announced quantitative tightening. And yet we're already starting to see the effects of that. Anytime the Bank of Canada signals to the market that they're going to be buying less bonds, that means that the supply relative to the demand is going to increase. So future potential bond buyers are going to want to see a higher yield when thinking about purchasing these offerings. The bond market was quick to react to that news, and the mortgage market wasn't far behind. In fact, a couple days ago, we saw a spike in fixed rate mortgage products from anywhere from 0.25% to 0.5% depending on the term. That means regardless if you were a variable rate holder or a new fixed borrower, you were impacted by that news. And in turn, it also means that the stress test has now risen again, meaning people are now going to qualify for even less home than they did before. It also means that landlords are starting to feel the pinch, particularly those that were previously in lower fixed rate contracts and are now finding themselves renewing into these much higher rates. Which means that number 5, you're likely going to see even more upward pressure on rents. Many landlords, as a result of these changes, are going to have to raise rents even more than they already have. I mean, there are countless articles out there with landlords indicating that the money they bring in every month is less than the money they've been spending any month. In fact, some of them go so far to say that they've even started slacking on certain maintenance because the cash flow problems and the costs are simply too prohibitive. On top of that, we still have a steady stream of immigration coming into this country, and because of the things that we just talked about, the odds that they're going to be able to buy a home is probably pretty low, which means that the disparity between supply and demand in the rental market is going to get even worse. So if you are a renter, hang on, because things are probably going to get worse before they get any better.